This article is coming from Yahoo Finance by way of Fortune. Jamie Dimon reveals JP Morgan has a war room that will meet up to 3 times a day as a potentially catastrophic default approaches. So we have 6 more days until June 1st, which is the deadline to see whether the debt ceiling rises or not. If it doesn't, um, there's going to be some problems in the global economy. Let's get into the video. So Jamie Dimon warned that the U.S. default would be potentially catastrophic and pleaded with politicians to please negotiate a deal before the country breaches its borrowing cap in early June. If the U.S. defaults on its debt, the CEO warned in a Thursday interview with Bloomberg TV, it would hit contracts, collateral, clearinghouses, and affect clients definitely around the world. Dimon expressed some hope that the U.S. would be able to negotiate a solution if markets began to worry that a default might happen. The closer you get to it, you will have panic in terms of market volatility. Okay, keyword volatility, market volatility. And while panic becomes something that's not good, if it gets to that panic point, people have to react. Dimon revealed to Bloomberg that JP Morgan is convening a weekly war room to evaluate the effects of the U.S. default. He predicted that the group would start meeting more regularly if the standoff continues, moving to daily meetings by around May 21st, and then meet 3 times a day if no solution is reached. So what is the debt ceiling? Congress sets a ceiling on how much debt the U.S. Treasury can incur and can pass legislation that increases the borrowing cap by a given amount. Okay, that might be good for Bitcoin as well. If the ceiling is reached, the Treasury is barred from borrowing more money to cover the expended obligations of the U.S. government. That would force the Treasury to stop paying for things the U.S. government has already committed to pay, leading to a default. White House economists warned that even a short default would lead to 500,000 loss in jobs and 0.6 reduction in GDP. Now, Treasury Janet Yellen has warned that the economic consequences of the U.S. default, calling it an economic and financial catastrophe that will be of our own making. Now, we also have a banking crisis going on, right? JP Morgan CEO also referred to another source of economic angst in his interview, the current crisis facing regional banks. Dimon, whose company recently acquired the failed First Republic Bank, said it wasn't interested in buying another faltering financial institution. We're going to have a lot of blowback having bought First Republic. All right, so reading between the lines, as we get closer to June 1st, and if there's no deal, there's going to be a lot of market volatility, which means that we'll have a sell-off in equities, and the VIX, which is the fair gauge, is going to increase. So what Jamie Dimon is saying is go short. In particular, the Russell. Now, why the Russell? Well, it has about 10% exposure to regional banks. In addition, in 2021, when we had the debt ceiling issue, the S&P dropped 17%, but the Russell dropped 24%. Market volatility. Now the VIX, the fair gauge. Back in 2021, it rose from around 20 to around 50, so more than 100% increase. So, say we don't get a deal. Let's go to the monthly chart. And say if the market volatility mimics 2011 and the Russell, this is the IWM, which is the ETF that tracks the Russell. So say if this debt ceiling doesn't occur or no deal is reached and we get a collapse like we did in 2021, 25%, at current prices at 175 would be in the 140 area. Now, How convenient. There are monthly buyers at that level. I'm going to set myself an alert. Now, one way to play the IWM, you can buy, well, you can buy the stock if you want to go long. The way to play it short is through the option market. And this is the IWM options chain. In this case, we want to look going out a month to the third week in June, but you want to look for puts. Okay, these are the calls. And these are the puts. So dollar amount at the money. The contract going out a month, 176 is trading for, each contract represents 100 shares, so it's about $374. Now, if price were to collapse to 140, that's a $35 dollar decline. 140. You can buy you can buy yourself protection for $8. Now you can see this is the open interest. You can see tons of people that already bought protection. You can see people that bought, and this is smart money, people that bought protection at 145, people that bought protection at 150, people that bought protection at 155. Wow, look at this, 160. Wow. Look at this, 165, 207,000, 211,000, 180. Oh, 170, excuse me. Now, how much would, say, a 140 contract be for $8? Like, if it price went down to 140, how much would it be? So to get an idea, you go to that the money, and you add 40 to that. So you get 216, and that's about 3,900. So $8. I can't even do the math. $8. If it went down to 140, theoretically it would be worth $3,900. So 3,900 divided by 8. I mean, you're talking about a 487x return. Insane, insane. But kind of just looking at the open interest, most of the volume's at 170. That's fair, right? That's very fair. The 140 is a lotto ticket, in my opinion. All right, now when it comes to the VIX, again, the VIX rose from 20-ish to 48 back in 2011. One way to play that is through VIX ETF. This is the VXX, which I have played in the past. Going out 1 month, third expiration contract in June. We want to look at calls. So at the money, 66 cents. Now it's down 65% today because of the rally in the stock market. But if we get a collapse, then these are calls. They would go up in price. So 100% return, which is what it did in 2011. Maybe you go out to $70, And let's see what we got here. All right, so I'm not seeing a lot of volume. And what's funny is that as you go out, the volatility increases. The market makers are somewhat pricing in a lot of volatility potentially coming up. Just looking at the volume here. All right, so what would be reasonable? We got a lot of volume at the 38, a lot of volume at the 41. Again, these are overpriced, more than 100%, but they're breaking in volatility. Let me go back to the Russell. That's the calls. All right, these are puts. Okay. Yeah, puts. Okay, so the volatility is a lot less. If I had to choose, I would play the IWM puts because the volatility is a lot less. It also means that they may not be, the market makers may not be expecting such a drop in price, which is why the implied volatility is a lot lower. The low risk trade would be closer to at the money, right? Because the probability of your contract getting in the money increases. But if you have conviction in that a deal won't get done, then you go out of the money. And based on the open interest, the 170 would probably be the best bet. Very liquid. 1 cent spread. Or you can just wait. You can wait to see what happens, which is what I'm going to do. If you actually get a decline in price, this is extreme, but we've seen extreme things happen. I'll be loading up at the 140 level. What's worth noting on the monthly chart, you have support resistance at the 170 level. Just something that caught my eye. All right, so Jamie Dimon, he's warning of a possible debt ceiling, no deal, what's going to happen. He's saying between the lines, buy some protection, go short the Russell, go long the VIX. Thanks for watching. Subscribe. Please like the video.